Hello everyone, welcome to my study table where management concepts are made easy. In this video, I will give you an introduction to accounting by telling you a story. Meanwhile, do subscribe to my channel if you haven't yet and press the bell icon so you never miss any updates from me. The story is about Myra and how she runs her business. Before we begin, let's understand what accounting is. Accounting makes it possible to systematically record financial transactions, analyze and report the recorded financial information, and communicate the financial health of a business to all interested parties and stakeholders of the business. Accounting is the backbone of any organization because every business needs reliable and authentic data to make informed decisions on investments and disinvestments, costing and pricing amongst others. Let us get more clarity on this and understand the basics of accounting. So let me tell you about Myra. Myra runs a small flower shop out of her garage where she makes and sells bouquets and other flower arrangements every day. She starts her business day with a cash balance of 3,000. The first thing that she does is visit a local flower grower from whom she buys flowers worth 2,250. On her way back to her shop, she purchases packaging material worth 750 for making her flower bouquets and arrangements. She sells all her flower arrangements and bouquets by 6 p.m. in the evening. Her total earnings at the end of the day being 5,000. And she does this every single day. After a month, Myra wants to know how much the business has made. What if she expanded or introduced new flower arrangements? Would it be more profitable or more expensive? Would it make more sense to move out of her garage and set up her shop in another location? Without a way of recording her daily business activities, it will be difficult for her to answer these questions. Accounting will make this possible. Not only will each financial transaction be recorded, but the analysis of the same through the detailed reports will help Myra take decisions for her business. These detailed reports that will summarize the financial performance for Myra's business is called financial statements. So now let's see the first financial statement that will help Myra analyze her profitability. That is the income statement. The income statement is also called the profit and loss account. In this, you could find out how much sales the business has made in a certain period, the costs incurred on the business during that period, and the resultant profit or loss. If the sales revenue is more than the cost, the business makes a profit. If the sales revenue is less than the cost incurred, it means that the business has made a loss. So the profit and loss statement for Myra would look something like this. Myra's income, or in other words her sales revenue every day, is 5,000. Now she spent some money on purchasing the flowers and packaging materials, isn't it? So as we saw, she spent 2,250 on flowers and 750 on packaging material. That totals up to 3,000 per day. This is called the cost of goods that we need to deduct from the sales revenue to arrive at profit or loss. To keep it simple, we won't consider any other cost for now, like rent or taxes. Now if we add this up, we can see that Myra has made a profit or a net income of 2,000. That's how simple income or profit and loss account would look like. Let's now have a look at the second main financial statement, that is the balance sheet. It is a tool that helps accountants visualize what the company owns and owes in one look. In other words, the balance sheet shows which assets the company owns and the liabilities it owes to others. Assets are the resources the company owns and uses for its operations. For instance, land and building, plant and machinery, equipments, inventory, and cash, to name a few. Liabilities are what you owe to others. For example, a bank loan, amounts that you owe to your suppliers, in other words creditors, and taxes. Owner's equity is another component that you can see on the liabilities side of a balance sheet. It refers to the residual amount that would be left if the company sold all its assets and paid off all its liabilities. In other words, it is the difference between total assets and total liabilities. This leftover money belongs to the owners of the company, hence the name owner's equity. As you can see in the balance sheet, the assets are on one side and the liabilities, including the owner's equity, is on the other side. The value of the asset side will equal the value of the liabilities side. That's because everything the company owns, that is the assets, was purchased from either borrowed funds, that is debt, or from owner's funds, that is equity. So in other words, total assets will always be equal to the sum of owner's equity and liabilities. This is called the balancing equation. Both sides are always in balance and hence the name balance sheet. And that is the foundation for any accounting system. Keeping this in mind, let's see how the balance sheet looks like for Myra. A balance sheet is always created at a certain point of time, like at the end of the business year or at the end of a quarter. In our example, it is at the end of Myra's business day. Myra started out her day with a cash balance of 3,000, which is also the equity that she put into the business. The cash, therefore, equals the equity. The balance sheet at this point is in balance. Then she spent 2,250 on purchasing flowers and 750 on purchasing packaging material. That amounts to a total cost of 3,000. The flowers and the packaging material is what we call her inventory. In this process, her cash got reduced to zero, but in exchange, she received another asset, that is inventory. The total amount of assets remains at 3,000, but of course, her equity too. Now, after selling her bouquets and flower arrangements, she earned 5,000 at the end of the day. Her inventory has gone since she has sold all her products, so at the end of the day, her inventory value is zero. She has earned 5,000, which is now the cash balance at the end of her business day. So the total on the asset side is 5,000, but on the liabilities side, we only have 3,000. The balance sheet is out of balance. As we know, this can't be. Both sides need to be in balance. So we need to find the missing piece. The missing piece is the profit she made during the day. As we saw in Myra's income statement, she had made a profit of 2,000. This will get added to equity. Reason being that Myra made her business more valuable. She earned 2,000 during the day, making the business worth more, which is reflected through a higher equity. So now if we add this net income to equity, the total on the liabilities side becomes 5,000, thus now balancing the balance sheet. And this is how Myra's balance sheet would finally look like at the end of her business day. She can now use this information to take further decisions for her business. I hope you really enjoyed this video. Do send me your comments and likes. It definitely keeps me motivated. And do subscribe to the channel if you haven't yet. And press the bell icon so you never miss any updates from me. Here's to happy learning, now and always.